So let's see question number 4. This question number 4 is focusing on the cash and its impact. So here in the question number 4, the first part is focusing on the theory. Here, the first part is focusing on the free cash flow to the firm. Actually, this free cash flow can be calculated in 2 ways. Right? So here it is focusing on the firm. So the formula is to calculate the free cash flow to the firm is first we have to take the EBIT. What is EBIT? EBIT is the earning before interest and tax. For that one, we have to apply the tax portion. So then we are getting the profit before the interest, right? And we are going to take the interest after adjusting the tax. Then we are going to add the depreciation and amortization. Why we are going to add the depreciation and amortization? We know that these two are only accounting entries. Actually, there is no cash inflow or outflow. Therefore, this expense should be added back. Then from that one, we are going to deduct the changes in working capital. So what are the working capital? Here we are focusing on the inventory. We are focusing on the debtors. We are focusing on the trade receivables or the creditors. So we have to add or minus these changes. So I have told you, right? So I have told you the impact on the changes in working capital in the cash flow in my video of cash flow analysis. So there I have explained you when the asset values are increasing, it is have a negative effect on the cash flow. When the debtors are increased, then there is a negative impact on the working capital. When the inventory increases, negative impact on the working capital. When the creditors are increased, since it is a liability, it's have a positive impact on the working capital. Therefore, you have to keep in that mind and you have to add or deduct the change in working capital to the free cash flow. Then from that one, we have to deduct the capital expenditure. The capital expenditure means the expenditure which we have capitalized. So in my analysis of long-lived asset, I have explained what are the tangible assets, what is the impact if we are going to capitalize that expense. So when we are going to expense that expense. So I will give an example. If you are purchasing a land, then the legal fees, are we going to capitalize or not? When you are putting a fence, are we going to capitalize it? Not. Right? So when we are leveling the land, are we going to capitalize it? Not. So you have to go through LK 16 to identify what are the expenses we are going to capitalize and what are the expenses we are going to expense in the income statement. So based on that, we have to add or deduct the capital expenditure. Most of the time, we are going to deduct this capital because it's an expenditure. So this is the formula we have to use to calculate the free cash flow to the firm. So this is the question they have given. So they have given the operating cash flow, they have given the interest rate, they have given the tax rate, then they have the depreciation, then the fixed capital expenditure, working capital expenditures, shareholders' dividends, then the net borrowing during the year and debt repayment during the year. Based on that, first we have to take the operating cash flow. So this operating cash flow is the profit before tax figure. For that one, we have already deducted the interest. Therefore, we have to add this interest of 40 rupees back. So we have to add this 40 rupees to the operating cash flow. Then we can get the cash flow before interest. Then we are going to take the tax. So that is 20%. So now we can calculate this portion by doing the arithmetical calculation as shown. Then next part, we are going to add the depreciation and amortization. So depreciation and amortization figure is 25. So we are going to add them because there is no cash involvement there. And here they say that changes in working capital is 44. So we have to deduct that changes in working capital. At the same time, we have to deduct the capital expenditure as well. So the capital expenditure here is 120. So we have to deduct that figure as well. So we can arrive at the free cash flow to the firm, right? As 157 after doing all the arithmetical calculation. These other figures are given to mislead you. So don't fall into that trap. For this one, you have to figure out what is the formula. Then you have to figure out what is the definition for the free cash flow as well. Now let's move on to the next one. Briefly explain the purpose of cash flow statement and how the statement of cash flow helped to overcome the shortcoming of the income statement and statement of financial position. So these three financial statements have three different purposes. Right? First, we have to elaborate that. Right? So main purpose of cash flow analysis to find out the details of cash inflows and outflows. So it shows you the cash flow, right? Cash inflows and outflows based on three different factors or three different modes, such as cash flow from operating activities, cash flow from financing activities, cash flow from investing activities likewise. So it shows you the sources of companies' cash. So what are the sources companies have taken the cash? Is it better based on the sales? Is it based on the this grants from the company? Or is it based on the loans? Right? So what are the sources? Are we use the creditors? Are we use the loans? Are we use the share capital? Are we use the sales income or the operational income? Likewise, the sources. And what are the uses of cash? So after earning these cash to the company, what are the ways we have used the cash? So sometimes we may use this cash to purchase. Sometimes we may use this cash to purchase assets, purchase stocks. Sometimes we may use this cash to invest in another company. Sometimes to repay our loans. Likewise, what are the sources we are going to take the cash? What are the uses of the cash? And over a period of time. Why I have mentioned this over a specific period of time? You know, in the cash flow statement, in the heading, we are going to write cash flow statement for the period. For the period means we are covering a specific period of time. So first we are going to explain the purpose of cash flow analysis. So it will give 1 mark. Then next one, we are focusing on the purpose of income statement. So income statement shows the performance of the company. So it show you the revenue, expenses, and earning for a period of time. So it reveals the ability of the firm to generate profit. So whether they are able to generate the profit or not, we can see by going through the income statement. However, this income statement does not reveal the amount of assets and liabilities and required to generate a profit. So it does not show you what are the assets and liabilities utilized to generate this profit. So as a result, right, it does not necessarily equate the cash flow generated by the firm. So at the same time, it's not reflect what are the assets and liabilities we have utilized to generate profit. At the same time, it's not reflect what is the cash out of these operations. So it's not reflected in the income statement. Then next one, you know that income statement is based on the accrual principle. At the same time, it's consider the non-cash items such as depreciation, amortization, impairment, etc. Right? Further, it has included the sale from non-current assets, losses from non-current asset sales, right, in the other income. Therefore, the accuracy of the document is questionable and misleading. But if we use the cash basis for accounting, it reflects what is the actual cash figure or the actual cash position of the company. Therefore, this income statement has forgone that main point and it serves only to calculate the performance of the company. Then SFP. SFP means the statement of financial position. So the statement of financial position represents the assets, liabilities, and equity at the end of the fiscal period. So you know that in the statement of financial position, we are going to write statement of financial position as at a particular date. Asset means we are going to take a snapshot on that particular date itself. So on that particular date, what is the balance of the assets, liabilities, equity, and represent in the statement of financial position. Since it does not reflect the result of the operations and some numbers listed in, it may be based on historical cost. So we know that this statement of financial position does not reflect the operations. So the operational value is reflected in the income statement. So at the same time, these figures recorded in the statement of financial position is based on the cost principle, historical cost concept. Therefore, these prices may be outdated. So to calculate the performance, this may not be relevant. Therefore, to overcome these loopholes of income statement as well as the statement of financial position, right, we can use the cash flow statement. So the cash flow statement categorizes the inflows and outflows into operating, investing, and financing. This can highlight the operational issues in a better way than the income statement, as well as the statement of financial position. Because if we have a negative cash flow in the operations, we can see the main issue in the operational activities. If we have a negative cash flow in the investing, we can see we have purchased new assets, but we have not utilized them in the operations. That's why we have a negative cash flow in the investing activities. Then in the financing. So in the financing, we can see whether we are taking a loan, whether we have issued new shares, what are the sources? Are we perform better in this sector? Likewise. And it shows whether your business cash flow is assertive or good or not. Cash flow statements are good barometer of whether firm's debt level are sustainable and whether the cost of debt is manageable or not based on the operating cash flow. So if the operating cash flows are good, it reflects we are going in a better way in terms of operations. In other words, we are carrying out our day-to-day main business activity. The main business activity sometimes can be buying and selling goods, sometimes providing a service. Are we efficient enough to generate a good cash flow from operations to cover up our investment cost as well as to cover up our finance cost? If not, right, what are the things we have to take? What are the non-value adding activities we have to cut down to modify these cash flows? So we can have a clear idea by going through this cash flow statement. At the same time, it will give further information with regard to the liquidity, solvency, and future performance can be predicted based on this cash flow. So if we are having a negative cash flow, then there will be a liquidity issue. If we have a negative net cash flow, then there will be a solvency issue as well. So if we are keeping these negative balances in 2 or 3 years, right, then there will be a huge issue in growth. At the same time, our future performance may be reduced because we can't invest, we don't have cash, so we don't have any other method to develop our operations. So there are several scenarios we have to consider in answering this type of question. So next one is accrual basis income statement and how we are going to convert into the cash basis income statement. So we know that mainly income statement is prepared on the accrual basis. Why we are going to prepare it accrual basis? To reflect the true profit figure or to reflect the true performance over the period of time. Right? And to convert it the cash basis, we have to remove certain items. We have to add back certain items. So let's see the transactions one by one and let's identify what are the things we are going to add and what are the things we are going to deduct. So the first one is written off goodwill of 25,000 included in admin expenses. You know that impairment of goodwill is not the cash adding activity or cash deducting activities. It's not the cash expense itself. Therefore, since we have already deducted from the admin expense, we have to, right, deduct it, right, from the admin expenses. So here it's included. So because it's included there, so we have to remove it. Then the next one. Depreciation of motor vehicles worth 12,500 included in the distribution expense. So the distribution expense of motor vehicles, right, is included in the distribution. So this depreciation of motor vehicle 12,500 is included in the distribution expense. Because of that, our distribution expense has been increased. So we have to deduct that expense as well to arrive at the cash basis. Because we have added it, now we are going to remove it from that expense. The earlier one also, we have added it into the admin expense. Actually, since the impairment does not have a cash impact, we are going to remove it. Since the depreciation does not have a cash impact, we are going to remove it. At the same time, if we have amortization also, we have to remove that expense. So for the goodwill, we have the impairment. For the intangible assets, we have amortization. For the tangible assets, we have depreciation. These three are non-cash flow items. Therefore, we have to remove it in order to arrive at the cash basis. Then the next one is asset disposal loss of 15,000 included in other operating income. So we know that disposal profit or disposal loss is not a cash item. Therefore, we have to remove it. Now, from the other income figure, we have already deducted this loss. Other operating income have a credit balance. This loss is a debit balance. Therefore, this loss has been deducted or reduced the other income balance. Now, to arrive at the cash basis, we have to add it back. So the next one. Gratuity provision of 45,000 included in admin expense. You know that provisions are just accounting entries, right? So it does not have any impact in terms of cash basis. Therefore, this has increased the admin expense. Therefore, we have to reduce the gratuity provision expense, which has been already added into the admin expenses. Why we are going to remove? Because it's just an accounting entry. Since this is just an accounting entry, our admin expenses has been already boosted up because of this 45,000. In order to arrive to the cash basis, we are going to remove it. Then next one. Closing interest payable has decreased by 6,250. So let's see the interest account. Now in the interest account, earlier we have 10,000. Now it has been reduced to 4,750. So the difference is 6,250. So this difference is due to the cash which we have paid, right? So now let's see the impact in the cash account. So in the cash account, this should be debited into the cash account. Therefore, we have to add them back. Now again, go through this one. Closing interest payable has decreased. So earlier we have 10,000. Now it has been reduced to 4,750, which means the change is 6,250. Now, this is mainly due to cash payment or cash we have received. Right? So let's see the other entry in the cash account. So in the cash account, we are going to debit this as the interest. Actually, what has happened? we have received cash for the interest. So this interest expense has been reduced by this one. Now, to arrive at the cash basis, what we are going to do, we are going to add it back. Now let's see the next one. The next one is increasing closing stock, right, by 35,000. So let's see the account as well. So in the inventory account, earlier we have 65,000. Now it has been increased to 1 lakh. So the change is 35,000. Now this 35,000 is reflect how much inventory we have purchased during the period. We know that if the inventory balances are increased, it is mainly due to purchase. So the purchase figure is 35,000. So let's see the relevant account. So in that one, the purchase account, we are going to credit as stocks 35,000. So to purchase these stocks, we have to spend the cash. So what will happen to the cash account? That will be credited. Therefore, in the cost of sales, what we are going to do, we are going to add them back. Right? So there is a negative impact here. So here, we are not focusing on the cash itself, right? You can record by putting it into the cash itself, it's okay. But here, what has happened is we have to focus on the purchases. So purchases means we have spent some cash. So that has been already deducted. So now to purchase, to prepare into the cash basis, we have to add them back, right? Which we have already purchased. This is just like adjustment. Here we are not going to reconcile, right? So we are going to adjust the cash basis. That's why we are going to add this one. Now let's see the next one. Decrease in tax payable. So let's create the tax account. So here we are decreasing the tax payable by 35,000. So when you go through the tax account, you can see there is a 35,000 deduction in the tax. This is mainly due to cash. So let's create the cash account. So in the cash account, we are going to add the tax as 35,000. So let's see the impact. So we are going to add.
Sir, okay. நான் கேட்டு சொல்றேன் என்னன்னு சொல்லி பாருங்க. இவர் ரமேஷாஜி வாரண்டாரு. கேட்டவங்க மரோ கால் தாரணை இப்ப.
Excuse me, can you mute yourself?
அவரு
So, right? Now next one. Increasing closing debtors. So let's see the account. So here we have 50,500. Now we are increased the closing debtors. So which means there is 49,000. Can you mute yourself? Right? So where we are. Okay. Now brought forward balance is 50,500. Now the carried forward balance is 1 lakh. So here again, what we are going to do, we are going to prepare the cash flow account, this T account, debtors account, and we are going to identify the impact in terms of cash. So this is reflect based on the sales. So in the cash account, we are going to credit this value. Therefore, we are going to deduct this in the adjustment to arrive into the cash basis. Right? The increasing fixed imbalance means we have purchased more sales. Right? So we are purchasing more sales means, right? In our sales account, we are crediting the cash. Therefore, in the cash account, we have to deduct that figure. Now, let's see the final one, that is the provision for doubtful debt. As I mentioned you earlier, this provision, impairment, these amortizations are non-cash figure items. Therefore, this provision has increased the current expense value. So we have to remove it back. Right? So since because of this provision, we have already incurred, right? So we are going to add it back into the administration expenses. Sorry, not in the administration expenses. This should be goes to the distribution expense. So let's see the net impact. Earlier one, this should be goes to the distribution expense, sorry. It should be credited.